Good afternoon, everyone, and welcome to the briefing. We're glad that you're here. And today we want to talk about where do we go from here. We've had an incredible run in the equity markets, a lackluster run in the bond markets, but we hear everybody saying, gosh, it's very high. What do we do? Where do we go? So we want to talk about that today. I'll start our briefing here. So where do we go from here? We see three factors that will affect our future. The first one is valuation. The second is risk. And the third is demographics. So valuations. Right now, we hear about how great the market's done, and it's been on an unbelievable run here the last 3 to 5 years or so, and even longer. And we look at the price earnings ratio, also known as the PE ratio. And so that is just a formula that's the price of a stock or an investment divided by its earnings. So by way of example, if we have a price of a mutual fund or a stock that's $100 and it's earning $10, then we will have a PE ratio of 10. A price earnings ratio of 10. Historically, that price earnings ratio for the S&P 500 has been about 19. So the price to earnings ratio for the S&P 500, which is the 500 largest US stocks, has typically been about 19. That price earnings ratio right now is 31. So as all of us probably think, we're concerned about that valuation, and prices have gotten very high. The news here is they have to come down, and they're going to come down. We can't tell you when they're going to come down, but they will come down. Earnings could go up, and that would change that price earnings ratio or the denominator, but earnings have been very good, and we feel like there's going to be a retrenchment or a correction at some point in the not too distant future. We just can't say when. So why is this happening? We blame Tina. Tina's not a bad old girlfriend. Tina is, there is no alternative. Right now, interest rates are very low, and that's illustrated by the US 10-year Treasury bond. The US 10-year Treasury bond is what the government sells to generate income to run the government. You pay, by way of example, $1,000 for a US Treasury bond, and for the next 10 years, you will make a whopping 1.3% interest. So part of what has run the valuations up on the stock market is the poor returns in the fixed income market. If you were looking at an investment and you could make 1.3% in the bond market, or you could go buy a dividend producing stock that paid 4%, which one are you going to choose? You're going to choose the dividend producing stock because no one wants to make 1.3% for the next 10 years. So there is no alternative, but the bond market is doing its job. By that, I mean, bond traders are the ones who create that 1.3% return, not the US government. The bond traders are doing one thing and one thing only, and they are trying to make money. So what the bond traders in the bond market have said, we will accept a 1.3% rate of return on the US Treasury bond. Now, the risk of a US Treasury bond is very small, because if the United States government can't pay their debts, it doesn't matter how much money we have in the financial markets. But the bond traders have set that 1.3 and they are satisfied with it. So we'll talk about what that means slowly and shortly here in a minute. But also when it comes to valuations, we realize, and most of you realize, that these types of returns that we've had for the last 3 to 5 years cannot continue forever. And this is an important point. A correction or a retrenchment, which we fully expect to happen, is a healthy sign of a healthy financial market. And the reason that is we'd rather have small decreases over a long period of time, say 1% decreases every other week, than a 15% drop, which we have experienced previously. People don't think straight, and it's much better to have a retrenchment or a small correction over time. And we certainly think that that is coming. So valuations, and this is illustrated in a graph here that is the S&P 500 PE ratio above the historical average. So 0 here is the historical average. And on your far left, I'm sorry for the fuzziness, on your far left is the dot-com bubble back in 2000. That's how high the PE ratio got before that bubble burst. You go all the way to the far right, that's where we are today. We're not quite as high on a PE ratio, but we're getting really close. And again, we are at a 31 on the PE ratio of the S&P 500, and that 0 is about 19. So valuations are very stretched and very rich. And as a client said to me today on a call, what goes up must come down, particularly when it's gone up by 17 or 18%. Thank you so much. So I'll repeat here. This is the S&P 500 PE ratio. On the far left was the PE ratio just prior to the dot-com bubble. And to the far right is where we are now. So we're not quite where we were back before the bubble burst, but we're getting close. And that makes us nervous. And as I mentioned earlier, a retrenchment here is probably healthy. The other factor we think that will affect where we go is risk. How much risk do we have in the stock and bond markets right now? Well, I just talked about valuations in the stock market, and they're very high. So we definitely have some risk there. The risk is earnings won't match prices in the PE ratio. But the other risk is that the stock market is cyclical. We know what goes up must come down. And so right now, there's a lot of risk in the stock market. There's also a lot of risk in the bond market. The bond market at 1.3%, at some point, interest rates are going to rise and are going to normalize. When that happens, bonds that are paying 1.3% that have been issued are going to decrease in value and performance will be poor. So the risk in the bond market is that interest rates will rise at some point. And we know that will happen. Again, we just don't know when. Now, when we think about risk, we think about short-term versus long-term. Short-term, there's some risk in both markets. Long-term, there is not risk, because as we look at historical averages for equities or stocks, and we look at historical averages for fixed income, we know that stocks will outperform bonds, but we also know that stocks will be cyclical in nature. So the point of that is, if we try to make a decision today that, hey, let's reduce our exposure or get out of the stock market, then we've become a gambler and not an investor, because we're trying to time the market. The same holds true for the bond market. We want to stay where we need to be, and that's based on the next point on your screen, hopefully, is your asset allocation. Asset allocation is determined by your risk tolerance and your time horizon. Your risk tolerance is how you feel when you put your head on the pillow at night, your nervousness. Your time horizon determines when you will need this money. So we use those two factors, or those two factors used to determine what your asset allocation ought to be. And in times like these, it makes a lot of sense to do the next thing, and that's rebalance your portfolio. So let's walk through a scenario. An investor has a 60-40 portfolio. Based on their risk tolerance and time horizon, 60% of their portfolio should be in stocks and 40% should be in bonds. Due to the run that we've had over the last 3-5+ years, their equity allocation, because equities have gone up, is now 70% of their portfolio, and their fixed income portion is now 30% of their portfolio. So on a semi-annual, quarterly, annual, it doesn't matter. On a regular basis, it makes sense to rebalance back to your target allocation. And in this case, we would sell stocks to get that equity allocation back down to 60%, thereby selling stocks when they've run up in value, and move that cash or funds over to fixed income, buying bonds or fixed income when their prices are somewhat depressed. That is what leads to true gains in the financial markets. Not trying to time the market, not trying to be a stock picker. So if your asset allocation hasn't changed, i.e. your time horizon when you need these funds, or your risk tolerance hasn't changed, then don't react to short-term fluctuations in the market or the thought that we have an overvalued market. That's risk. And here's a graph of some risk. It's a little small and I apologize, but what the blue shows is the price earnings ratio of the S&P 500. What the red shows is the price earnings ratio of the international markets. We favor the US market from an equity standpoint over the international market. But when you see that divergence there between blue and red, and the PE of the international equity market is much cheaper, it's on sale, it makes sense to rebalance part of your portfolio back down to international equities because there's more value right there. Again, you don't want to get out of your original asset allocation, but you want to rebalance back to the target. The third factor that's going to affect where we go from here is demographics. Locally, nationally, and across the world, birth rates are rapidly declining. We're having less babies. And we are an aging population. Those two go hand in hand. Other countries, such as Japan and Germany, have already experienced a great deal of this. And if we compare our 10-year treasury to Japan and Germany's, their rates are actually negative. So I referenced that the United States government is paying 1.3% on a 10-year US treasury. Japan and Germany have negative rates on their 10-year treasuries. We investors are paying those governments to hold that money for them. And the main driver of that are demographics, both in Germany and Japan. And you can see here, it's estimated that Japan by 2100 will have dropped the population from 125 million down to 75 million. A very big drop. So how does all this affect the financial markets? Well, we've all heard about Social Security, but there are other private companies that are in danger of not meeting their funding commitments. So Social Security is an easy one. We know that Social Security 20 years ago, the baby boomers were contributing to Social Security during their working years. Now a majority of those baby boomers are taking Social Security benefits, and there's not a baby boomer generation to refill the Social Security expense. And so Social Security has, by all estimates, about 10 years before it goes broke. We don't believe that will happen. There'll be some things to mitigate that risk. But the same thing is happening in the private sector. About 20 years ago, pension plans were much more popular than they are now. A pension plan offered by a company was one that said to the employee, we're going to guarantee you a certain dollar amount in your retirement for the rest of your life. Since that time period, 401ks and individualized plans where the individual takes the risk have become much more popular rather than guaranteed pension plans. But on many books of many companies are underfunded liabilities. And what that means is the promises that were made to previous employees, those promises were made based on the fact that life expectancy might be 72. Now they're having to pay those employees, former employees who are retirees, through 78, 85, and even longer because we're living longer. That's putting a strain on those companies' balance sheets and P&L that at some point will probably affect those companies and the financial markets. Here's an example of what's happening with the aging of our population. In 1950, about 8% of the population were over 65. It's estimated by 2050, almost 23% of the population will be over 65. And the example I just gave of pensions does not take into account the cost of healthcare. That's going to be a problem as well. So there are three factors that we think will affect where we go from here. Valuations, which we discussed, are stretched. The S&P 500 PE, or price earnings ratio, is at 31. That's historically been 19. Risk, there's a lot of risk in the market right now, illustrated by low interest rates. And then demographics, we have an aging population that we're going to need to take care of and that we haven't saved for. Those three factors, not any one in and of themselves, are going to affect what happens in the financial markets moving forward, and certainly bear paying attention to. People were kind enough to go ahead and send in a couple questions ahead of time, so I'll go ahead and address those, and hopefully I'll stop sharing here. There we go. The first question was on taxes. We've had a new tax bill that's been proposed. It's in that Ways and Means Committee. And what does that mean for us? We're paying attention to three sections of that bill. The first is the increased tax rates for individuals and corporations. Tax rates have been historically low for the last 3 or 4 years, and at some point they had to go up. The second thing we're paying attention to is the increase in the estate tax. That exemption right now is about 11.2 million, and nothing is set in stone, but from the bill, it looks like that's going to drop down to about 5 million. And the third thing we're paying attention to is the elimination of the step up in basis. The step up in basis allows for a step up to fair market value when someone inherits property from a deceased person. By way of example, let's say someone dies and they have a $100,000 piece of property. They bought that property for $10,000 many years ago. When the person inherits that property, if they turn around and sell it the next day, their gain will be zero because they got a stepped up tax basis of $100,000. If the step up in basis is eliminated, they would have a $90,000 capital gain when they chose to sell it. A lot of planning goes around the stepped up basis, so that's worth paying attention to. The second question we had was about inflation. If we would revisit inflation, which was the topic of our briefing last May. So I mentioned the bond traders really are setting interest rates, and right now interest rates continue to be low. We see a lot of data on how much inflation has gone up in the last year. Think about where we were last year. Nobody was going on trips. Nobody was going out to eat. Nobody was traveling. Nobody was doing much of anything except buying exercise equipment. Well, now we have much more demand because although we're not back to normal, we're more normal than we were a year ago. And there's more demand than there is supply. And part of that supply issue also is shipping, trying to get goods to market through a pandemic. We believe inflation is transitory. We don't think we're going to go back to the inflation of the late 70s and early 80s. We think we'll see some inflation, but nothing to be greatly concerned about. But the thing that you want to pay attention to with regard to inflation is labor costs. As many of you know, it's hard to find good labor right now. That's going to be a leading economic indicator of when inflation is coming. We hope this has helped. This gives you an idea of where are we going from here. And we're happy that you were on the briefing today. And we hope to see you next time at our next briefing. Everybody be safe and take care of each other. Till next time. Bye-bye.